Yeah, this session actually introduces you to uh, the high level overview of the equity securities. I mean, what kind of securities are there in the equity market, right? When we say equity, is the most common thing we think of is common shares. But apart from that, what all are there, and what is the entire process? That entire aspect of the theoretical aspect of the equity securities is what we are going to look at in this session. So to start with, see, when we talk about equity shares, we talk about these many varieties. There is a common share, or there are some callable shares, there are putable shares, there are preference shares, there are cumulative preference shares, there are participating preference shares. There are so many variants in terms of the shares itself. Whenever we talk about, the most common things we always talk about are either the common shares or the preference shares. These are the two common things which we come across. So whenever we are talking about a common shareholder, the most important thing for us is, in case the company is going bankrupt, first the lenders will take away the assets to the extent of their claim, to the extent of the loan which they have given. The lenders will have a take on the assets of the company. Anything which is left over is what is being taken over by the equity investors. That's where we always say equity investors have a residual claim. In case the company is winding up, or in case the company has gone bankrupt, or in case the company want to shut down, the amount that the equity investors will typically get is nothing but whatever is that portion of assets that is left over. That's where we always use this word, right? Assets equal to liabilities plus owner's equity, the balance sheet equation. See, liabilities are all something which are taken by others. Assets are everything which the company is, the monetary worth of what the company is having. So the difference between these two is what the equity investors are going to get, right? So that's where we say they have the residual claim on the firm assets. And most of the equity investors, they actually participate in the governance of the organization. They can enter as board of directors, so they have voting rights. We have looked at these aspects as a part of corporate governance chapter also, which we have covered earlier, right? And the difficulty side is they don't get a fixed return on their investment. If we are talking about a lender or someone who has given loan to the company, the interest is paid on a yearly basis, and that interest is fixed in most of the cases. So at least the lender will know how much he is going to get every year. But with respect to the dividend which has to be given to the equity investor does not know how much he is going to get, because the dividend policy, I mean, the whatever the dividend that is going to be paid every year can be decided by the management in that particular year. So in some years, if they want to retain more money, probably the dividend payment could come down. So there is a lot of uncertainty or variability that is associated with the dividend, because there is no legal requirement or legal obligation also to pay this much of dividend every year. Whereas in case of interest, at least if someone has not paid the interest, it can very well be treated as probably default, and it could even decrease the credibility and the credit worthiness of the company. But if a company doesn't pay dividend in a particular year, it does not decrease anything of that sort for the company. So that's where companies always show some kind of interest in terms of the dividend, in terms of equity shares. Then in this equity shares, we have a small variant. Of course, not every company will use that, but there are very few instances across the world in terms of two small variants in the common shares called the callable as well as putable. Actually, these are more in line with the terminology of the derivatives, which is the options area. Callable is something which can be called back. The shares which can be called back, which is like a buyback of the shares, and putable is the shares which can be sold back. So whenever we say callable, it means if it is a callable share, it works like this. When a company wants to buy back the shares, it's an agreement. See, today, let's say I'm issuing a shares, I'm raising new capital. The prospectus of this itself will clearly say that these shares are callable after 3 years. Callable doesn't mean that we will buy back. Callable means if we want, we will buy back. Otherwise, we will not buy. So the decision is with us. The decision is with the company. If it wants to buy back the share, it can very well buy it back at a fixed price. It can decide the price today itself. Probably 3 years later, we will buy back the share at 200 rupees a share. So when will they generally buy back? If the market price is, let's say, 250, the company thinks buying it back at 200 is a good option. So let's buy back and reduce the number of shares in the market. But if the market price is only 150 on that day, if at all we have to buy back, we need to buy it back at 200. Why should we buy it at 200? They'll say, okay, you continue as shareholders. But when the company decides that it wants to buy back, people have to sell it mandatorily. People cannot say that we will not sell. So that option will be there. If that option is not there, if people don't want to sell their shares, no one can do anything there. Right? Let's say if the option is there at the time of issuing of the share itself, if the company has issued a callable share, it means now the decision is in the hands of the company. If it wants to call back, it can very well call back. But if that option was not given at the time of issue of the share, it means, okay, if the company still wants to call back, the shareholders need to agree for that. If you have to make your shareholders agree for that, probably you may have to give some kind of premium or something for them. You may have to pay a premium or something so that you can call it back. But if you have issued a callable share, you can call it back at the price you have decided due at the time of issue itself. That's an advantage. So callable shares always have the benefit of issuer, not the investor. Right? Because the company can call back whenever it wants, not the investor can decide. Whereas the putable share is the other side. It gives the investor the right to sell off whenever he wants. Right? So that's where you don't find many companies issuing putable shares at all. Because no company wants to give the benefit to the investor. Because that may create even other problems. When the share price in the market is going down to, let's say, 100 rupees a share, this guy wants to sell at 200 rupees a share. It even creates the company to even more fall drastically. Only some companies, especially in their very initial stages, if they want some good capital, they give these kind of benefits. But no established company can think of giving a putable share at all. Right? Because it gives you an option to sell your share at a fixed price. That too you can decide. So they will always use that option when the market price has gone drastically down, so that they can still sell it at such a high price. That is the characteristic of a putable share. And then we have also talked earlier also in terms of preferred stock. Preferred stock also, there is no maturity period. Forever it can go on, just like your equity share. May or may not. For a preferred stock, it can either, in general, it does not have a maturity period, but it can get converted again. Or, let's say a private equity investor, he generally takes a preferred stock in the company shares. He will not take the equity share of the company's stock. He takes the preferred stock. Whenever a private equity investment happens in any company, he will take the preference share. The reason being, generally he will get the dividends that are fixed in amount. Just like an interest on a loan, the preference shareholder will get dividend which are fixed, whereas a common equity holder, dividend is nothing fixed. Whatever is left, they may get. So equity shareholder, generally also a preferred stocks are issued to companies which are not that heavily established. Private equity investment you hardly see in very established companies. You will see in companies which have a very, they have a promising growth, but they are very small today. In those kind of companies, you look at preference stock or private equity investments lying to a large extent. So there the problem is, if I leave it to the management to decide the dividend, they may not give any dividend at all to these guys. So that's where they enter always with a preferred stock kind of a scenario, so that they'll get a fixed proportion of dividend every year. They don't get into the voting rights and all, but whenever they want, they can pull out of their investment. Right? They'll sell it to someone else, or they convert that into a common equity and take the company to IPO. All these things are very much possible, but in its literal sense, preferred stocks also do not have any kind of a maturity date kind of stuff. And in that also we have a small variation called cumulative preference shares. It means, see, we are saying dividend should be fixed, right? But in case the company did not make a profit and it could not pay dividend in a particular year, right? If it is a non-cumulative, it need not pay the dividend. Even if it did not pay the dividend in this year, that's over. Next year it has to pay that year's dividend only. Whereas when it gets categorized as a cumulative preference share, whatever the dividend the company has missed out because of non-generation of the profits earlier, even those all need to be accumulated and paid before a rupee is paid to the common equity investors. Let's say for last 2 years, the company has not generated a profit, right? So obviously it cannot pay dividend to the common equity investors, but it did not even pay to the preferred equity investors also. But third year, let's say it has made a profit. Now what this cumulative preference share say is, because you did not pay our dividends in the last 2 years, before you actually end up paying the rupee to the common equity investors, you have to clear our last 3 years dividend. Only then you can pay a rupee to the common equity investors. So even before a payment can be done to the common equity investors, the cumulative preference shares, if it is a cumulative preference share, the dividend including the arrears have to be settled before the dividend can be paid to the common equity investors. Then there is one more variant called participating preference share. Anywhere you use the word participating, it means participating in the profits of the company. See, generally we have been saying that the dividends are fixed, right? For preference shares, generally the dividends are fixed percentage. So when it is a participant preference share, it means that if the company has generated a very excess profit, more than some targets are set, if the company generates a profit beyond this limit, you need to get some additional share in the dividend. Until that profit, you have to get only fixed profit. Until that profit which the company has generated, you will get a fixed dividend. But if the profit of the company crosses a certain limit, the share in the dividend also will be given, provided that it is a participating preference share. If it is a normal preference share, only your fixed portion, that's it. So all these things have to be clearly observed when we are looking at the prospectus of the company. What are the characteristics with respect to voting rights? What are the characteristics with respect to callability, putability, or even convertible? We have seen in our EPS calculation scenarios, whenever we talk about a convertible preference share, it can be converted into a common share at a predefined kind of a price. So we need to see for two, three things, whether it is a preference or a common equity share. In that also, does it have a callable or a putable or a convertible kind of an option? And does it have a cumulative preference share or non-cumulative? Is it a participating preference share or non-participating? These kind of aspects we have to see, because the equities which are issued into the market could fall into any of these criteria altogether. There is again a small difference when it comes to voting rights. This also we have discussed earlier in corporate governance. Some companies, what they do is, with respect to the shares, especially with respect to the voting rights, they divide the shares into two classes, class A and class B shares. So for class A shares, they may say one share equal to one voting right, one vote. Probably for class B, they may say one share equal to 10 votes. So obviously, if this kind of a differentiation is there, it means the company doesn't mind giving you more and more shares, but it has an issue in giving you the voting rights. Because they may issue for a common public, they may issue one share equal to one vote kind of shares. Whereas with the promoters, they'll keep one share equal to 10 votes. So it may very well happen that when it comes to all critical decisions, the management who will hold the class B shares, they'll have a say in the voting process. Because okay, if there are 1,000 votes, right, probably 50% of the or 60% of the shares are there with the public and 40% with the management, or probably 80% with the public, 20% with the management, right? Even in that case also, if you talk about the voting process, let's say all 80% of the people are voting against the company for some decision, it will be equal to 80 votes, right? 80 people out of 100 shares, 80 shares, all of them want to vote against the company, 80 votes. Whereas the management, 20%, but 200 votes, because each share equal to 10 votes. So they will win whatever is the decision they want to make. They'll get their decision passed out. So these kind of things also we have to clearly see. Are there multiple classes of voting rights, or is it one single itself? Because when a company is especially diluting its stake very heavily, right, only the promoters want to hold only 20%, remaining 80% they want to give to the public. In these kind of cases, we have to really see whether such kind of a clause is there or not, right? Then we also talk about in the equities part, we have just now talked about a private equity kind of investment. See, why someone wants to go for a private equity kind of an investment? Sometimes we use the word private placements also. Private equity kind of investments are generally required by small companies generally, because one, the reporting requirements are much not stringent, right? Hardly I need to show my financial statements to you, that's it. I don't need to put them on the website of the company, right? I don't need to make them public. I can just show it to my private equity partner, and that's it. And because of that, what happens, see, if this is one important aspect, I can focus on long term prospect. See, generally when I attract investments from the public through an IPO or something, majority of the investors have a short term focus. buy, I mean, they buy the shares today, probably within 2 months, if the share price goes up, they'll try to sell it off. I mean, they have that trader mentality rather than the investor kind of a mentality in a large number of people. So, from that prospect, what happens is, yeah, if a company doesn't give dividend in 1 quarter, suddenly you will see that too many sell offs are going to happen. And that too, for a small company, any business, we have to understand that it takes some time for stabilizing of that particular business. So, the returns will start coming only after a certain number of years. So people, if they find, because not every investor is rational, he may not think through the long term investment process. So what companies will be forced to is, they cannot take some long term decisions, right? Because if they take long term decision and probably do a very major capital investment, suddenly the share price will start falling. So they cannot tolerate those kind of stuff. So that is where the focus, at least for those kind of companies which are focusing for a very tremendous growth. Why only small companies? Even big companies, let's say Tata acquiring Chorus. Chorus, from a public company, it has been made a private company now. The reason being, if it is a private company, you have all kinds of flexibility in terms of restructuring it, because you don't have the burden of the small time shareholders increasing the shares and decreasing the share price, and playing around the trading mentalities, because they are generally long term assignments. Turnaround will take good number of years, and people need to have patience for that many years. So that's where what they say is, we'll get in some private equities. Okay, these guys will wait for 3 4 years, 5 years, but they want a tremendously positive return. When there is a good idea or a good prospect for that company, obviously we can wait for 3 4 years, because whatever is the return that is expected, it can generate after that 3 4 years kind of. So that's where we see that the potential, wherever we see a private equity investments, there are long term prospects on that. So because of that, there is a potential for a great positive return once the company is taken public at a later point. Whereas, but the biggest problem is, they are illiquid. Once I have invested in a private equity investment, if I want to get out of it, it takes some time, because it is not tradable in the public, right? Probably it's like this: you have invested in my business, now you want to get out of it, right? Now my business is not listed on any exchange. So where do you sell that? Where do you sell off your share? And that too, it's an equity investment. It's not a loan that I have to repay you, right? So there is no commitment from me to repay you. So you have to find someone else who can sell it. Who can buy it. So that's where we say they are very illiquid. And because of that, even the disclosure requirements. See, what I will showcase about my company is very limited to you, right? You may ask for whatever you want, and I can show only that, but not the entire thing which probably a SEBI might ask as a part of its disclosure requirements if the company is listed public. And even there could be a high chance that the corporate governance is very weaker with these kind of companies, because I am not responsible to any public. So my corporate governance wise also, I may not have so many independent directors for this company. Probably my family members only might become the directors of this company. So there may not be much of independence also associated anywhere. So the corporate governance generally will look weaker with these kind of companies, where private equity investments are much more in number. Then when it comes to equity, the next aspect which we generally look at is non-domestic. Like an Indian trying to buy non-Indian securities, or an Indian company trying to sell its shares outside India. See, today we see Infosys or any of these major software companies, right, or even some of the telecom companies, we see that they are listed on US exchanges. on Nasdaq or NYSE, apart from being listed on Bombay Stock Exchange and National Stock Exchange, they are even listed on some US and Europe kind of stock exchanges also, which means they have sold their shares in the foreign market, in the dollar market, or in the euro market, or in the pound market. They have sold their shares in the foreign markets, right? And so, what are the various mechanisms that are there for investments in the equity securities in the abroad market? Investors, so when we are talking about buying a foreign stock directly, let's say an Indian person, individual, he can buy the stock of a foreign company. How? Whenever we are talking of a return, the return is also in the foreign currency. We always use the word FIIs, right? Foreign institutional investors. They are the foreign investors who are investing in the Indian stock markets, and the returns will be in the Indian rupees itself for them. So the exchange rate plays a very important norm there. But of course, whatever they are investing is guided by the Indian stock exchange regulations. Even if a US company is investing in the Indian market through the FII kind of a route, they have to abide by the Indian stock market's regulations. So even when they have to sell off their shares, there is a possibility of being less liquid and less transparent, and maybe involved with a lot of foreign exchange kind of issues. They may be, forex fluctuations, the exchange rate fluctuation and all may impact them, because they have to again convert it back to their own currency to really check out on the real returns, right? That's where if there is a huge depreciation of the local currency that is happening, sometimes we may see some investors, right, whatever is the returns they are getting, when they are converting it back to their own currency, it may not be significant for them. See, now when you are, let's say you have invested when $1 equal to 50 rupees, right? When $1 equal to 50 rupees, you have invested in the Indian stock market. So you assume that you have invested $1, right? Okay, the stock markets in India have grown by, let's say, 10% in a 1 year period. So your 50 might have become 55. You have invested $1, it got converted into rupees in the Indian market. So 50 rupees is what you have spent in the Indian market. For that 50 rupees, let's say after 1 year, it has become 55 or 60 rupees, right? 10% or even 20% return. So that 50 has become 60. But in the meanwhile, the exchange rate has also gone to, the rupee has depreciated and the exchange rate has become $1 equal to 60. Now you convert it back into dollar, you are left with only $1 again. Though you got 60 rupees here, you have to convert it back into dollar. You are getting only $1 because the exchange rate has already become $1 equal to 60 rupees. So though you got 20% return in the Indian market, when you translate it into your own currency, it's no return at all. So these are some of the risks that could be associated, especially with the investments in some foreign currency markets, right? Now, that is where we have other options of purchasing what we call as depository receipts. A foreign company itself. Now, this is the case where a foreign investor, or probably an investor is investing in a foreign company directly in foreign currency, right? Whereas now when we talk about the depository receipts, it is like foreign company is issuing the shares to a domestic investor in his domestic currency. Like Infosys is traded on US exchange in dollars, not in rupees. When a US investor invests in Infosys in India, it is like he is investing in rupees. But when a US investor purchases the depository receipts of Infosys in US, it's as good as he is investing in dollars itself. And there may be some kind of a trading that happens on the US exchanges itself. So that happens only on a dollar basis, not on rupees at all. So from that standpoint, we talk about either global depository receipts or American depository. American depository is nothing but all US dollar denominated. Again, it's a matter of American dominance. For US dollar denominated securities, we specifically call them ADRs. But any other any other currency denominations, we call them as GDRs. So if they are listed on US exchange explicitly, we call them as ADRs. If they are listed on any other exchanges across the world, we call them as GDRs. But they are not, they are the ones listed outside the domestic country of the issuer. And Infosys issuing outside India. If it is listing in US, we call them, they can list it through the issue of ADRs. If they are listing in UK or Luxembourg or any other exchange, they are issuing GDRs, right? And if they are done in multiple currencies, not just US dollar or not just pound, not if it is in one currency, we may call them as ADRs or GDRs. But if they are in multiple currencies and multiple stock exchanges, right? Some in US, some shares in US, some shares in London Stock Exchange, some shares in Japan Stock Exchange. In that case, we call them that they are issuing global registered shares, not depository receipts. They are giving a global registered shares kind of stuff. And of course, the another scenario is about basket. So which is nothing but the fund. A fund is created now with all the GDRs and ADRs. So let's say I create a fund. I'm a fund manager who will invest the money. I'll pool money from all of you. I'll invest the money in only these ADRs and GDRs. There is a exchange traded funds that are created with only investments in all the ADRs and GDRs, a combinations of ADRs and GDRs that are typically created. That is what we call as a basket of listed depository receipts. So these are the various kinds of non-domestic equity security investments that can very well happen. Then when we talk about the returns, we all know when it comes to equity securities, the returns are of two types. Dividends are given at regular intervals and capital gain or loss is there from change in the share price. But of course, the third thing comes exclusively for FIIs depending on the foreign exchange gain or loss. See, normally we have seen holding period return formulas, right? Whatever is the intermediate payment plus whatever is the change in the price divided by the original price. But what we are saying is here foreign exchange gains or losses also are added, especially if I have a foreign FII, foreign institutional investment kind of scenario. I can even get some gain or loss because of change in the foreign currency, not because of the change in the stock price, not because of change the dividend that is given by the company, but because of improvement in the stock price, improvement in the foreign exchange rate, I may get some kind of a benefit or even I may lose also. As we have seen in the earlier example which I have discussed, you have invested when $1 equal to 50 rupees, right? So the share price has gone up by 20%, it became 60 rupees. But what you have really got is zero, because when you have translated that 60 back to your own currency, you have still got $1 only. So the 20% loss also is there because of the depreciation of the Indian rupee, right? So that's how you calculate your total return. And See, whenever we get some kind of dividend in the middle, right? Whenever some kind of dividend comes out in the middle, we are looking at reinvesting of that dividend, right? That's what will, let's say if I want to compute, that's nothing but IRR, right? When I reinvest the dividend and at the same rate as IRR, whatever is the overall return I get for, let's say I'm keeping my investment for 5-year period, right? In the middle, the company is giving me some kind of dividend. If at all I want to find out for this whole 5 years what is my overall return, all we are saying is it's better that we compute the IRR for it, which is again assuming that all the dividends that are declared intermediately, they are reinvested back at the IRR. If I am not able to reinvest them back at the IRR, my overall return will be slightly lesser than the IRR itself. And we have also used this statement earlier also. Preferred stock is less riskier than the common stock, because there is a fixed amount of dividend that gets paid every year, so the riskiness is slightly lesser. But of course, for a very highly performing company, the return is also much lesser, because equity investors dividend may be much higher compared to what a preferred stock dividend may be given. But yes, less risk, less return, that's a very common funda which we have been following right from the beginning. But the only advantage is preference stock investors will receive the dividend first before even a rupee is paid to the common equity investors. So that way, the priority in the payment is much higher, and even the priority in the claim is also much higher. If at all the company is closing down the business, they have the first claim into assets of the company. And we have also talked about putable shares and callable shares, right? Putable shares are always less risky, because as we said, putable shares give a benefit to the investor. He can decide when he wants to sell off the shares. So as an investor, he is very happy. Any company which is giving putable shares, the investors are very much interested in buying those shares. That's where you don't find any company giving putable shares. Whereas callable shares are more risky, because they are at the benefit of the issuer always. Whenever a company wants to call back, it will call back the shares. So generally, many companies feel like issuing callable shares, especially if they are in a thought process that will give more shares now, but will buy back some of the shares at a later point. If that is the kind of mindset the company is operating in, then they will prefer going for a callable shares itself. And when we talk about cumulative versus non-cumulative, cumulative are less risky, because even if a company did not pay a dividend in first year, at least you are sure that it is accumulated and it is paid in the second year. Whereas in a non-cumulative, any missed dividend, you cannot, you are forgetting that dividend. See, before paying to the equity investors, a preference share investor should typically get it. But if the company avoids paying them to both of them, it can very well do that. But if we are talking of a cumulative preference share, if it has done like that, next year it has to pay the arrears also. But in a non-cumulative, there is no need to pay the arrears the next year. So whatever the equity capital that comes into the company through the IPO process or through the preferred process or whatever is the process, once an equity capital comes into the company, it is primarily used to buy the assets, fixed assets, right? Long-term capital always has to be matched with long-term assets, whether it is long-term loan or long-term equity. Equity is generally long-term in nature. You don't expect that this person will pull out his money after 2 years, right? So any of these kind of investments are generally used to buy machines or plants or equipment, buildings, vehicles, which are generally long-term in nature. And in some cases, some portion of it can be used to offer salaries, operations. For operations standpoint, majority of it will go into the purchase of the productive assets. But for some companies for whom productive asset is nothing but employee itself, right? For service oriented kind of companies, they don't have too much of infrastructures and everything. Everything depends on the employees. So they'll try to pay good compensations to the employees and these kind of stuff because they are completely service oriented kind of stuff. And this actually, the more and more equity capital is given, obviously your debt to equity ratio will come down. If the debt to equity ratio comes down, the riskiness of the company will come down. That improves the credit rating of the company, and even it provides a scope of liquidity if at all some short term loan has to be taken at some point in time. Because now our debt to equity ratio is much lesser, we can raise capital for short term borrowings quite comfortably, right? Probably at a much cheaper rates of return. Another important concept that we need to see here is book value versus the market value of the equity. We see book value is nothing but whatever is this is the book value of equity, which is nothing but assets minus the liabilities of the company. This is what is equal to the book value of the company, which is purely from the financial statements. It has nothing to do with the stock market and performance of the stock market or trading. It is nowhere involved with all those activities. It's purely based on retained earnings, right? Profit, internally generated profit, how much portion is paid in the form of dividend, how much portion is retained back. That is what is contributing to the book value of the equity. Whereas, and typically if the profits of the company are high, there is an expectation that the retained earnings also will be higher, because the company will pay some portion of it as a dividend and the rest of it will be retained. Retained earnings are higher, which will very well result in the equity also. I mean, again, the equity portion also typically increasing. But what we have to typically talk of is there should be some level of relationship between the book value and market value. Market value, though it is purely from the stock market standpoint, number of shares multiplied by the share price, right? But what we see is, unless the book value is high, I mean, generally, no investor wants to buy more shares if he knows that when the company winds up, he gets nothing. Right? No investor wants to buy the shares of a company when he knows that he will get nothing when the company is winded up. So there is a relationship between the book value and the market value. Of course, most of the investors, that's the reason they look at market value to the book value ratio. That's actually coined as P by BV ratio, price to book value kind of a ratio. If it is very high, people say the company is overvalued and they don't prefer investing in this company. If it is much lesser, it's an indication of the company being undervalued and probably attracting more investment with vis-a-vis the competition or the historical or the industry average. So that is what is the relationship between the market value, because market value is more about from the stock market standpoint, whereas the book value is more from internal performance kind of a standpoint of the company. Then when we talk about the other word which we generally use is cost of equity versus return of equity. Right? What are the difference? See, if it is in case of debt, debt, cost of debt and return on debt are more or less one and the same. Because what it costs to the company is same as what the lender will receive. See, if a lender is receiving 8% on a loan, the cost to the company is also 8% on that loan. So in case of debt, what we see is cost of debt is same as the return on debt. But these two are two different things when it comes to equity. When we say cost of equity, because there is no fixed payment from a company's standpoint. See, in case of debt, there is a fixed payment from a company's standpoint, or in case of preferred stock also, there is a fixed payment from the company's standpoint. So what is the cost for the company is same as return which the investor is receiving for that. If I say 10, so let's say you have lent me, you have given me a loan of 100 crores at 8% interest rate, right? So from a company standpoint, 8 crores every year is the interest, which is the cost to the company. And as an investor, what you are receiving, as a lender, what you are receiving is also 8 crores, which is the return on your investment. So generally, in case of debt, these two words are one and the same. But when it comes to equity, these two words need not be one and the same because there is no fixed payment. There is no fixed payment. So when I say cost of equity, it is purely based on the CAPM equation. What is the cost based on the risk return profile? It's not the dividend which the company is paying, because we know that it's not a fixed payment. Even the portion which it has not paid, even the portion of the profit which it has not paid, that also belongs to the equity investor only. See, in case of interest, once the company pays off that 8 crores, it need not pay anything else to that guy. And that guy cannot expect anything else from the company. It's over. The transaction is over. Whereas in case of equity, that's not the case. If it pays some dividend, right, whatever the remaining portion which it had not paid also belongs to you only. The only thing is the money is being used by the company for later growth. So that's where we are saying whatever the dividend that it has paid, plus whatever the rate at which it is growing, because that money also is yours only. That money is also yours only. So whatever the rate that it is growing, this entire thing is what is the typical cost of equity for us. Right? From a company standpoint, this much has to be paid to the investor. Or the other way to talk about is, generally people also use the CAPM equation. We have seen cost of equity can be measured with 2 or 3 mechanisms. So what we are saying is, based on the riskiness that is associated with the company, we are seeing that minimum of this much of payment has to be made to the equity investor. So this is what we are calling as the cost of equity. Whereas when we talk about return on equity, it is purely the net income divided by the shareholders' equity. So how much real profit the company has generated, right? How much real profit the company has generated. This is purely from a financial statement. How much real profit the company has generated for the equity capital that is invested within the firm. So what is generally expected is, as long as the ROE is greater than the cost of equity, it's like the company is exceeding the expectations of the investor. Cost of equity is what is required to be paid based on the risk return profile. Return on equity is what is the percentage of profit which the company has really generated as a proportion of the equity capital. So as long as the ROE is greater than the cost of equity, we can very well say that the company has exceeded the expectations. Company has exceeded the expectations is an indicator that there will be a lot of more investments that are going to come up into the company. So which means the stock price can rise in future. But if ROE is less than the cost of equity, we can very well say that the investments will fall in the company, which will lead to the share price of the company going down in the future. That's how we link the cost of equity with the return on equity on the investment.